Rolling options is one of the most powerful tools traders have, but most people don't really understand when to roll, why to roll, or how the math works. In this video, we'll break it all down: the logic behind rolling, the situations where it makes sense, and real numbers to show you how to do it right. What rolling means. Rolling is simply closing one option position and simultaneously opening another, usually with a different strike, expiration, or both. Rollout. Extend the expiration further into time. Roll up or down. Adjust the strike higher or lower. Roll diagonal. Change both the strike and the expiration. Think of rolling as repositioning your trade while keeping your thesis alive. Why traders roll? Rolling isn't about avoiding a loss. It's about managing risk and opportunity. Traders roll to buy more time. If your thesis hasn't played out yet, you can push the position forward. Lock gains. Roll strikes higher or lower to secure profits while keeping exposure. Adjust risk. Move strikes to reduce downside or rebalance deltas. Avoid assignment. Shift short options away from dividend X dates or expiration pin risk. Rolling is a proactive choice, not a panic button. The math of rolling. Let's look at real math. Say you sold the 100 strike put for $3. The stock drops, and now that option is trading at $6. You're down $3. If you roll out 1 month, maybe you can sell the same strike for $8. You buy back the losing put for $6, sell the new one for $8, and collect a $2 credit. Now your net credit across both trades is $5 total, instead of the $3 you started with. You've extended time and improved break-even. But here's the key. Rolling doesn't erase the loss. It restructures the trade to give you more probability to win it back. When rolling works, and when it doesn't. Rolling is effective when your thesis is still valid but needs more time or better positioning. It does not work if the market has completely moved against you and your thesis is broken. In that case, rolling just digs the hole deeper. The pro's rule of thumb. Roll when you're adjusting, not when you're hoping. Best practices. To roll the right way, use credits when possible, so you're not paying to stay in a bad trade. Check new break-even levels. Make sure they actually improve your odds. Mind liquidity. Wide spreads make rolling costly. Have an exit plan. Rolling should be part of your playbook, not a desperation move. Rolling done right is a strategic adjustment, not a bailout. To recap, rolling means closing one option and opening another to adjust strike, expiration, or both. Traders roll to buy time, lock gains, adjust risk, or avoid assignment. The math shows rolling can improve credits and break-evens, but it's not magic. Done with discipline, rolling keeps you in control of the trade. That's how pros extend, adjust, and stay strategic. Thanks for joining us. If you found this breakdown useful, hit like, subscribe for more strategy deep dives, and comment below. What's your biggest challenge when rolling a position?